Hello and welcome to this working group. Can digital and paperless trade help the ESG agenda? My name is Eleanor Wragg and I'm a senior reporter at Global Trade Review. Joining me for what promises to be a provocative and solutions-focused conversation are four experts who need little introduction, but introduce them I will. We have Michael Vrontamitis, who is an advisor at Kountable Inc. and the World Trade Board. Iain MacLennan, VP of Trade and Supply Chain Finance at Finastra. Merisa Lee-Gimpel, Head of Innovation and Trade Transformation at Lloyds. And Alexander Malaket, President of OPUS Advisory Services and Managing Director of ESG Validation. So welcome to you all. In this panel, we are going to look to join the dots between what's going on in the digital world of trade finance and the whole area of ESG. So as a bit of a scene setter, it's really well-trodden ground at this point, right? But I think everyone can agree that the COVID-19 pandemic has accelerated existing trends in trade. And the two real standout trends have been ESG and digitalization. Now, until recently, these have been seen as discrete areas, but it's becoming abundantly clear that you can't have one without the other. And that's what we're going to delve into today. So just to kick us off, I think I'll start with you, Michael. How is the industry now looking at this issue and this convergence between these two trends?
Thanks, Eleanor, and good afternoon, everybody. So I think what we're seeing increasingly in the industry, and in the banking industry in particular, is this linkage between lending and deposits, where depositors, initially corporates, but we're beginning to see some announcements around retail depositors as well, or consumers choose essentially for a lower return to ring fence their money towards ESG lending. And there's an element of trust in that at the moment, because that ring fence, I haven't seen it being very formalized, and I'm not sure you're sort of relying on the institution that you're trusting with your money to be using ESG standards, but those standards are not, as I'm sure we'll discuss later, particularly well defined or overly defined perhaps. So I think that's kind of one of the main trends that I'm seeing right now.
Yep, I think that's a really interesting comment to start us off. As one of those institutions that have ring-fenced areas, Merisa, I'd like to hear a little bit from you.
I think it's interesting, and definitely, as you say, Eleanor, that we've been having in the space of trade discussions on ESG and then discussions on digitization. I completely think they are obviously interconnected. I'd go so far as say you can't do a proper job on the ESG side and accelerate path to net zero if you don't have digitization. So it is a necessity. Some of the information that you need to capture to look at a trade transaction from an ESG lens is within the data that is currently captured in the trade flow. So, the description of goods, who's buying it, who's selling it, but so much more of that data isn't even captured today yet, right? Like soil content, all of that needs to be somehow measured and put into kind of the flow, and you need to get that data. So even if we look at like what we already have today at the moment, you've got that information mostly in pieces of paper, isn't it? So it's almost like for us to really look at green trade, sustainable trade, in a scalable way, you really need to move away from paper, and we almost need that digitization. I think you mentioned that the pandemic, obviously it accelerated things. I think it started things. It's putting us in the right path, but we're nowhere close to being anywhere saying that job is done, especially on digitization. We are totally at the beginning. I think, Michael, you just sent a LinkedIn message this morning, wasn't it? Like your article was like, it's a great start, but we are just at the beginning. And I think the challenge is when you look at climate change, and I was at COP, a couple of days last week, and it really spoke to me. We don't have that much time and luxury to wait a few years for this to happen. We need it now. It's a code red. It's a crisis. It's all of that. Trade has a lot of, a big part to play in that. Really, it really does. But I can't imagine how we scale it up without proper digitization. And I'm hoping the guys on the panel have the answers to it.
Fingers crossed, that's what we're here for. Alexander, I'd like to turn to you because especially your work with ESG validation, you've been doing quite a lot recently in sort of tracking and monitoring and so on. How far along are we with this convergence between the ESG side of things and the digitalization side of things?
Yeah, thank you, Eleanor. Hi, everybody. And look, I wanted to say that digitization is going to be absolutely useless to advancing the ESG agenda, just to be a little bit interesting, but I can't do it. I can't convincingly argue that point. So I think we're going to be in violent agreement broadly on that theme in the panel. But I want to pick up on a couple of points from Michael and from Merisa around the state of ESG and that conversation versus where we are in the trade financing space. If I'm succinct on it, the ESG space at the moment is very nascent and very, very messy. According to the OECD, there's a report in 2019, there's something like 120 different rating systems and scales around ESG in the world today, which is completely unsustainable, if you'll pardon the choice of expression, and completely inconsistent. You can see household names on different scales ending up at either end of the spectrum, doing extremely poorly, extremely well. The quality of the rating, there have been a couple of instances where people have been given very high ratings, and then 2 weeks later you find that they're using indentured labor in their production. So there's some real work to be done in the assessment process here. So the trust question, I think, is huge, but there's a lot of work to be done. The digitization question, and Merisa, I'm glad you brought in sustainability because, to go back to the definition issue, ESG, of course, is environmental, social, and governance. I would add the sustainability element to this, just to be clear, and tie it to the SDGs. The other piece of this, and we've done this at ESG validation with our clients, is to bring in what somebody else called an additional E, which is the economics. What are the commercial realities that we need to tie to the ESG to make them compelling as well? Because there's only so much that will come from pure altruism and doing the right things and all that. There'll be an element of that, but we need to drive it. And part of what will drive it is private sector motivation and commercial realities on the ground. So I think there's some interesting linkages that we need to make. To your point, Merisa, I think it is code red. I mean, the shipping industry contributes something like 3% of global greenhouse gas emissions, which is about twice what Canada produces and approximately what Japan produces, which is completely untenable. And of course, the industry has called that out. There's been some real attempts to advance that. And there's a whole slew of analysis being done in the aviation sector and all of these areas which are fundamental to the movement of trade globally. So we have a lot of work to do, and we need much more urgency, both on the ESG dimension and on the trade dimension, from my perspective.
Excellent. I think that's really, really interesting. Iain, I wanted to sort of back this over to you because I know that Finastra, on the one side, you're doing a lot of digital, a lot of you're a fintech, but you've also got this sort of collaborative ESG program. You've really got the sort of the focus on sustainability of late. How do these two sides marry together, and what kind of response are you getting from the ecosystem?
So I think the guys in the panel have called out a number of really interesting things. There's the question about the focus that's come on ESG, and I would say E&S, because G's been a focus since I think about 2008, since the financial crash, around about board visibility, the governance of companies, and all of that, and it really has taken the focus. And really, in the last couple of years, the E&S has come to the fore, along with the sustainability part around about that. But to Marisa's point, we don't really have that much time to get it right. We don't have very much time to paraphrase Greta to blah, blah, blah. We need to get on and actually deliver that. So I think from Finastra's perspective, we've always pushed, or Simon and the company push open by default. So for us, it's looking to bring together the required parties, the required data. I mean, digitalization spans trade end to end. It's not just ESG. It's everything we want to do in regards to trying to take away. I thought our title was interesting when I saw the word paper, and I'm just saying, no, paper, no, it has to be digitalized. It has to be open. It has to be, we need to get away from little data islands. And we talked about this before in other webinars around about how do we bring it together. So we're seeing lots of interest in regards to how do we make data accessible, and particularly in the ESG part, it's, to Alexander's point, what's your trusted source? If you go and you've got different scales and to use the example he had, one day you're good and the next day you're found out to have, indentured labor, it's like, how can you trust And a lot of what we do now is, what is the element of trust that we have in the systems, and can I trust what's in front of me? So it's an interesting time, but I think also where Michael called out consumers, I think what we see now is the sort of tripartite of consumers, investors, and regulators. I think that's where you start to see, we will see much more movement around about how we do that. Merisa.
I had 2 points to build that. I forgot one, but definitely one was not to add a bit of controversy, but just to build on what you said. You said no, but I want to call it like no but, because we have so many obstacles that make us step back and say, oh, actually we have to solve for something first. But like everyone said, we don't have enough time. So it's almost like the no but, how can we start today? What can we do now? And I get really excited when Alexander and the likes of Coriolis and other people say, actually, there's a way now, we can do this today, and then we could just build on it. So we can't just do projects kind of like the traditional way where it's a waterfall and you do one and then you do two and you do step 3 and then in 2 years you're at step 100. We have to do things in parallel. I think the work the ICC is doing at the moment on sustainable trade finance definitions is amazing. And then in parallel, we should go ahead and look at what the private sector can already do today, and private-public collaboration, all of that. But what can we already start kind of measuring, viewing, and putting in the hands of businesses to use today, as we have also the other things fall into place. So we definitely don't like paper, but today at the moment it is still paper. So what can we do with that? I remember the second point, sorry. And it's the duty, the role that trade can have in this ESG, because a lot of times, like exactly like you said, it's about the company, and a company is so vague, isn't it? Like at one point in time, they may do something very great, and then they would have gone against another SDG, and it's hard to rate at an overall company level. But with trade, you have the opportunity to look at that transaction, and there's so much in that transaction. What is the underlying good? Why? Who is buying what from where? What are they going to use it for? Where have they sourced it from? And how do we kind of build that transactional story? It's less biased. It's more specific. And I'm hoping there are really bright fintech technology partners and tools out there that are kind of available that we could start using, and probably in a way where there's not digital islands and there are bridges, right, Michael? Bridges and somehow we can use it. It's usable. The economics work. I get really excited.
From my perspective too, Merisa, and I appreciate the points that you're bringing in, Iain, as well. First on the G element, I've heard one argument that if we get the G right, actually the ENS and the rest of it should fall into place. So I think we still have some work to do on the G, although I agree with you that there's been some very significant focus on best practices, and there's some standards there that are more advanced than other areas. The other point I would bring in terms of the practicality, Eleanor, that you asked us to kind of hone in on, is the question of where should we really be focusing our energies and our priorities for the biggest bang. And I'm going to say, and I think there are at least two sort of quasi-Africans or partial Africans on the panel here, that reducing GHG emissions in Africa is not going to be what does it. I mean, when you think about where the impact is, it's not there. It's not typically in the emerging markets. It's typically in the large OECD economies. And we're in a ridiculous situation now where at least a couple of multilateral finance institutions that I'm aware of have been told by their effectively OECD developed market boards, thou shalt not finance coal, which is all well and good, and it reads well in the headlines. But in some places in the world, coal is life and death. And those places are typically not big contributors to the crisis that we're facing. So let them have their coal, let them survive, let them have a kind of a practical path to be weaning themselves off unsustainable or non-renewable energy. And then let's put our focus where we can actually have some impact on this.
Absolutely. I think that feeds in. Sorry, Michael, go ahead.
No, go on.
I think that feeds into this sort of a thread that's running through this, which is around, basically what is ESG and standards and so on. Because like you said earlier, Alexandra, and like you echoed, Merisa, there are some, companies that rank very highly, and then the next minute they don't. And I was at a roundtable of trade finance heads earlier this morning, and one brought up a really interesting point, which was, we've got now the green loan principles, the social loan principles, the sustainability linked loan principles. And he said, well, let's be honest, we haven't changed the deals that we're doing. What this means now is that we can just label some of the deals as green, and it hasn't actually changed the underlying. So I think there's a conversation to be had around assessment techniques, around, you know, ways of looking at ESG, because otherwise I think we risk sort of greenwashing. And I know, Michael and Alexander, you and I have had conversations on this before. So Michael, you know, in your view, what needs to be done to avoid greenwashing and to actually ensure that, you know, if we are aiming towards better ESG performance, we're actually not just ticking boxes?
Well, I think the first thing is we tend to mix up the climate emergency with sustainability.
Yeah.
And the climate emergency, I think the metrics are much harder in terms of carbon emitted. Measuring it is not that easy, but it's easier. Whereas sustainability, you know, when you look across all the SDG goals, I think 26 of them or 23 of them, Alexander remind me, but you know, that's where the 400 plus different standards and so on come from. So I think, you know, we have a climate emergency today. There's specific actions that we need to take around that, and we need to understand the difference between transition and helping industries transition, which I think, to Alexander's point around coal in the emerging markets, versus you know, supporting green energy. And obviously the price of green energy has come down quite significantly, and you'll see that, you know, it's not going to be an easy conversation on that front, right? Because even the most environmentally friendly nations like Norway are going to have challenges around the energy transition because they're a big oil producer. Yeah. And they need the oil money to fund the transition. Same with other Middle Eastern countries to fund the transition. So it's not such a simple conversation, but I think there's the climate emergency which you need to deal with, and then the sustainability, and the question really is, you know, how do you get around this? And I think you know, Iain mentioned it's about credibility. It's the credibility of the information. Now, the banks, we're not going to have time to wait for the world to fully digitize. It's just not going to happen in the next 10 years. I mean, as much as we dream about it, and you know, we've had some great progress in certain areas, it's just not going to happen. So there needs to be solutions that are around there, and there are some that are there. And for me, you know, and I want to just pick up on Alexander's point. The answer is multinational corporations, right? Multinationals make up about 50% of global exports. They make up about 70%, or if you include large local corporates, 70% of local imports. And the OECD, the top 20, the G20, make up 80% of global GDP. So if you focus on that, which is multinational corporations headquartered in the G20, then you're going to solve 80% of the problem. And you know, not only that, but I think there was a stat, if I remember correctly, from UNITAD that said that 80% of global supply chains or value chains goes through transnational corporations. So even SMEs that are not exporting, that are producing goods locally, that add value to something that then gets exported, is done into these transnational corporations. So that's the focus. That's where the focus should be. And it's not a problem that banks can solve for directly. Unfortunately, I think, you know, it is about labeling. And it is going to become, it's going to become like, is this project meet these criteria, or does it not? And if it does, I can say it does. And if it doesn't, I can say it doesn't. And therefore, I either reduce my capital to that project or those types of projects or not. At the moment, banks don't even know which projects are, you know, good from an ESG point of view on minimum criteria. They can't measure it. To Marisa's point, everything is in paper in the trade shop. On the lending shop, you know, it's based on conversations. Banks have traditionally relied on KYC due diligence and sort of annual sort of diligence on a client to determine their ESG status. I mean, that's what the leading banks are doing today, and a lot of banks aren't even doing that. Right? So I think the first step, and I think the ICC Sustainability Group last year announced guidelines of what that questionnaire was for banks to sort of pick up on. that weren't doing it today. I think you can. There's some first steps that can be taken. So I think the reality is going to come down to the credibility of the information, and it's going to come down to the due diligence of the banks to start with. I mean, until we get to a digital solution.
And the good news is there's momentum around this. I'm sorry, Merisa, you very politely put your hand up and I just jumped in. Sorry, please go ahead.
No problem. I just wanted to build on Michael's point, and then feel free to agree or completely disagree with me. But I think he raised a great point about, this is about trade and value chains, and we're all interconnected, and we are more than the sum of our own emissions, if that makes sense. So we're here as Lloyds. Part of what we call green finance is our own emissions as well, and our supply chain. But a lot more what we can do is obviously our lending book and the transactions that we're facilitating, but also we've got Scottish Widows. It's, we have to see what levers we have, and as Michael says, these multinational corporations, they can look at their scope 3 emissions, right, and then they can play a huge part in that. And I don't know if Rebecca is on the line, or I can see her name there. But we have these chats saying we can't leave SMEs behind because the information that we're trying to capture often, and Rebecca said hi, comes from them. When we look at what the ICC is proposing on this, the definition saying, okay, well, it's who's going to make sure that they have that they can produce the data to get that ESG score for that trade. Well, it's the exporters. It has to come from the exporters. So I think it just has to be easy, workable, doable, so that companies of all sizes can feed in and I guess present that data that then kind of is evidence, is trusted, it validates that maybe that, from an environmental perspective, yes, it is green and environmental, and not at the cost of any other UN SDGs if the focus is on climate. I don't know if anybody wants, yeah, Alexander's got his hand.
Yes, I'm following your example here, Merisa. So on the SMEs, actually, which is what I wanted to bring into focus before you intervene with your comments, was to say the other piece that has to be for the SMEs is urgent. And most of them, as we know, are cash poor, resource poor. They're basically living from one invoice or one sort of settlement to the next, and don't really have time to be thinking about sustainability and ESG and all those sort of niceties. The thing I think, and we've had this conversation with an interesting organization in the UK that's in that space, to say the thing that will make this imperative for the SMEs is actually the large buyer driving the imperative down the supply chain. And so that's where, I think, Eleanor, you raised the question or the point, or maybe it was you, Iain, that brought in the regulatory piece. That's also the other element. Once the regulatory conversation matures, then you've got the motivation to the large buyers, which will drive the imperative down the supply chain to the SMEs. And that's one way to sort of take a kind of holistic approach to all of this. And I wanted to also mention that the ITFA is also picking up sustainable trade financing as part of its work program. So there's some real momentum building around this. And I think that we have some opportunity to do something, a few really concrete things that will solve multiple problems. And I think that's where we should be focusing. So in terms of the thesis for this panel about digitization, in my head, I think is, yes, it's useful and it'll help, but it's not the solution, and it may not be the place where we need the most focus at this moment. I think we should let digitization progress the way it's progressing, incrementally advance it, make sure ESG is in the frame, but to solve the ESG and sustainability problem, I think we really need to hone in on it specifically, and not wait for the, Michael, to your point, wait for the digitization problem to be resolved.
Iain, over to you.
Yeah, I'm just going to reflect a little bit on what Merisa said in regard, but then it also comes to the point that Alexander's just made. We just need to get on and do it, right? I mean, I think the bit is if we wait to the points that have been made eloquently by a number of the panelists, is just, we can't wait for digitalization. We have to go on and start, continue the journey now. I just reflect sometimes that perhaps there won't be one driver in regards to consumers or regulators. I think potentially the biggest driver will be investors in those multinational corporates that you mentioned, Michael, in regards to the UN investment criteria that's been published. So I think we will see much more push from those companies in regards to, we can't invest in you unless you are compliant. And all of it will work itself out in time in regards to what's the correct standards and how we do it. I think by doing, we'll drive the standards. By doing, we'll drive the digitization. By doing, we'll fundamentally move the dial in regards to ESG. I just think that we just need to get on and do it. And there's a number of companies out there. And if I think reflecting back to Merisa, we'll never find a perfect company. It doesn't exist just now, but what we'll find is means by which we can start the transaction, look at the company, look at the flows, and be able to provide a much better view than we have currently, and people can make objective choices at that point in time, or objective decisions as to yes or no, or I'm sorry, we can't do this. I mean, we see it in other parts of the business already. In green finance, it's like, I can't finance you. But I take Alexander's point as well around about just be aware of the impact of what you're saying in regards to coal in developing areas where it's the lifeblood of what's being done, and it can't just always be a hard and fast rule on a global basis.
I think the other challenge here, Iain, is that we all have a different view on sustainability depending on the price, right? So the panel previously was really interesting because there was a gentleman talking about the bottling of drinks and how supermarket shelves were providing, putting bottles. Plastic was the worst, and then cans are the best, but cans are the more difficult to produce and cost higher, whereas plastic was cheaper to produce and cost less and was easier to execute on. And the reality is that cost is a major player in this. And so I think we talked about economics, but if you are buying $100 t-shirt, you'll take the time to check the label, scan the QR code, find out who the cotton farmer was that actually produced the thing and all that sort of stuff. But if you're buying a $3 white shirt, you don't actually care. Even it's the same person, you don't care. You'll buy it from the market and you won't check the ESG label because there isn't one. But you won't not make that decision because everyone's doing the same thing. And so, cost is going to play a really, really important thing. And consumers have shown over time, they're not willing to pay more for additional ESG. Some are, right? But the vast majority are not. And so, as costs go, and this is, I think, one of the key issues is that, corporates don't, while they want to be ESG, and they have to figure out a way of doing it in a cost neutral way. Otherwise, they become less competitive, and the non-ESG product wins out anyway.
I think it's an interesting point, isn't it? There was a Nielsen survey recently that was just under 75% of consumers wanted to know all of the details, exactly as you said, Michael, in regards to where are the ingredients, how are they produced. But I do wonder if there is a price point, to your point, in regards to will we be willing to pay more to ensure that we meet ESG standards.
I see it with my own behavior, right? And I would challenge anyone on the call to not see it with their own behavior as well.
I think that's a good.
Sorry, Alexander, go ahead.
Sorry, Eleanor, just quickly, this is a good place to bring in the whole carbon pricing conversation, right? So does the price of the t-shirt, including the $3 cheapie that you buy at the market, actually reflect its cost? And does it reflect the externalities of producing that t-shirt that need to be priced into it? So for people who talk about a carbon tax, I don't like that expression because it implies a kind of an arbitrary policy decision that the tax rate is X. I like carbon price because actually what it says is there's a discipline of analytics that goes behind determining what's the external cost of that you're pricing into that calculation. So the carbon pricing becomes part of the discussion. And to Michael's question, I think the other element is informing consumers. So the investor community is a little bit ahead of us in this respect. The pension plans and all that have been thinking about this for a while. If you start to hear as a consumer that the t-shirt you just bought is produced by forced labor in North Korea, maybe you'll give it a second thought and say, actually, I'll pay the extra $1.50 for the slightly more expensive and more decently produced t-shirt. So I think there's an awareness raising piece that's part of this discussion as well.
Yeah, I don't know, right? I'm going to disagree with you on this one, Alexander, because we all have iPhones, right? We all have an iPhone, we have a Samsung, and all the rest of it. And this has got parts in it that's made in the Congo, and they send kids down in the mine to get the stuff, right? Well, we're not using them. Everyone on this call is using them. So yeah, I get it, but it's not quite there, right?
I think
I'm not saying it's the solution.
Overarching issues, but sort of how do we then bring this into action, and how does digitization enable us to tackle this? We've got a huge gap at the moment in terms of monitoring ESG products or sectors or activities at a transaction level. We've spoken about scope 3 emissions and supply chains, but supply chains are massive webs, and it's very, very difficult, particularly, you know, if we think about sectors like mobile phones, like garments, for example, it's often very difficult for the end user or even, you know, the end buyer to get visibility over if there is child labor, if there are, you know, environmentally iffy practices. So this is where I was hoping to get some insights and perhaps maybe some action points of what can we do with the tools that we have available today to get, you know, transparency, to get visibility, to get data that can inform decision makers. What's available in order for us to link together this digitization that we're seeing with this wider ESG agenda?
Yeah, can I start with that? Because and I'm gonna talk about Rebecca Harding's work, and you can correct me when I'm saying something wrong, but I got really excited because you know, the project Coriolis and Cosmos is all about starting with what we know. So you know what the good is, it's got an HS code, you know who's buying, who's selling, you know the countries that are involved at the moment. So if you just start with that, she made a really interesting point about just having that information and that data, you know, stuff that Mike's talking about that, you know, could happen in the background. It's not really come to fore because it's just like, you don't see that on page one. But if we can bring some of that information more up to the fore, what about looking at, you know, the illegal logging, right? That's illegal activity, but so why is it still happening and still being financed? And she's got a really cool way, maybe she can talk, I don't know if she can unmute or you know, talk about that example specifically. But you've got with the right data, and I don't even call that digitization or not, maybe the paper is still involved, but if you just had that data, we have better visibility of when things shouldn't be happening that are happening, so that we can definitely step away from kind of those. I don't know what, Mike, you think about that, or Rebecca?
I think there's the other part, which is what you're calling it, Merisa. To me, at least, the way I'm put it is there's the phrase, "What sunlight is the best disinfectant." So in regards to being able to see, so I agree with Michael's point that, you know, we are hypocritical to some extent, that we kind of know about the Congo, we know about other areas of questionable practice, but we still all have our iPhone or Samsung or whatever. But I think if we make it much more visible in regards to the practices, you will see a change in behavior, because, you know, the other consumer surveys will tell you, you know, 85% are willing to pay, and I saw a comment pop up a little while ago that are willing to pay slightly more to ensure that they have an ethical product, whatever you want to describe as an ethical product. But there is this part around about taking the data that we have to make it visible, and actually that will impact as much the practice of the company as other companies within those sectors by making it visible about what is actually happening.
Yeah, Iain, I couldn't agree more on that point. The North Korean labor example I used as a headline that hit the news here last week, and within 24 hours of that headline, one of the retailers that was identified in the story took all of the products off the shelf within 24 hours. So they said, no, we want nothing to do with this. It's even if we're going to lose money, it's going in the bin. To Marisa's point, and Eleanor, to your question about some practicalities, and I think we touched on a couple early on, but there are some very promising developments. So I don't necessarily want to call out a particular solution, but, you know, I will, because it's just, I'm not pushing anybody, but IHS Markit, for example, has some very interesting capabilities because they issue all of the IMO numbers for the vessels that are sailing around the world in terms of commercial vessels. And so based on that, and based on some tech that they have, they can give container level and product within the container level visibility about what's going on with the shipment and where it is, and, you know, how it's been moved, and any number of other things that would be interesting and important from a financing visibility perspective. And to add, Eleanor, to the list that you raised earlier about the different sustainability initiatives that have been around in finance, including green bonds and all sorts of things, the Equator principles that live in the export credit world have been around for 2 decades probably. And they consider some of the issues that would impact sustainability would be relevant. So there are some lessons learned that we can pick from some longer time frame experiences. And I think some of the tech around supply chain visibility is becoming extremely powerful to be able to address some of the issues that we talked about on this panel.
Yeah, and I think it goes beyond just kind of trade trade finance and kind of the banks, because I mean, it's all about the overall value chain. So it's the buyers and the suppliers. If you look at where we play a part in documentary trade, obviously it's just 20% of that flow. So it really goes back to the underlying trade as well. Yeah.
I think the point around independent rating is absolutely critical, and using data that's available, and even identifying data that isn't currently available, but you can access it. So there's a whole bunch of ESG or sustainability rating agencies, for want of a better word, that are out there. You know, the challenge at the moment is they're not interoperable. So, you know, one rating from one is not the same as a rating from the other. So, you know, we'll get there. I think we'll get there over time, but starting to use them is actually the most logical thing to do, because you can start to create visibility around what you're actually doing, where you're sourcing from. You know, there might be practices in an organization you're not even aware of, you know.
Yeah, and I got really excited when the IFRS board said they're going to set up the standard, you know, to start measuring it away, because one of the problems with you have the greenwashing is because every company is just reporting in a slightly different way, in their own way, and it's really hard to compare apples with apples. So I think that's a good step, just to overall kind of generically, and we have to think about how we can do that in the trade world, and then therefore by definition the trade finance world that we're all in a party to. So.
Well,
hopefully we're in the right discussion.
Well, Oswald's on the line, so we just give the problem to Oswald, don't we?
And he's got not much time to solve for it, so definitely less than 12 months, let's say, because it is code red.
I think there's perhaps a point to be sort of developed a little bit further around adoption of all of these things that we're talking about, right? Because it's true, there are several different initiatives underway around ESG. I saw in the comments box an audience member put in about the sustainable trade finance guidelines that are in sort of Swift's KYC registry. So you've got an independent ESG reporting repository that already exists. You've got various different initiatives. Merisa, you brought up what Coriolis is doing. There are various other initiatives that are allowing for the provenance of goods to be tracked. You know, we're seeing banks like yourselves and others who are launching kind of sustainable supply chain finance programs that involve sort of, you know, tracking what suppliers are doing. But all of this is disparate. All of this is kind of unconnected. And I think that, you know, it's worth delving into what needs to happen to bring all of this together so that we get that kind of end-to-end sustainable trade. Where are the barriers to adoption for these kind of things?
Do we think there will be a consolidation? I don't know. Does the panel think there might be that's kind of what the IFRS sort of is going to, where it's a consolidation of, just to make lives easier for everybody involved on how we act. It's a question for me. I don't have a opinion on that.
Yeah, I almost think it's imperative, Merisa, and partly here I'm going to be very candid about an observation that we have come up with at ESG Validation with our ESG hat on, which is, and it's not a knock on anybody and any individual institution's work, but it's a reality of the market, which is that some of these firms who've developed these rating scales and systems will come in and rate you, typically not particularly well, legitimately or not. And then the interesting part that happens is that they then sell you consulting services so that next year when they come and rate you, you will rate better. So there's kind of, in our view, a bit of an inherent conflict of interest in that structure, for which reason I'm happy to see IFRS and SASB and others come in to give that regulatory sort of objective perspective to that dynamic. So it's an interesting space, and because of its nascent character, I think we still have some things to sort out in terms of how these things actually happen.
Yeah, I think Michael called it out earlier on, right? It has to be that independent nature in regards to the standards. I saw Michael laughing as well in regards to just reflecting back on where have we seen rating agencies before have an issue in regards to how they rate particular instruments. Yeah,
correct.
Sorry, Michael, I interrupted you.
No, I said correct. Yeah, I agreed. I think the key issue in my view is going to be the verification of data that's introduced into the data flow in the supply chain. So when we did a project with CISL, I was involved in a project with CISL called Trado, which had a number of these players on it. And the key problem was actually getting the data onto the blockchain and verifying that it was true. And because once it's on, it's a source of truth, but is the truth, so to speak, right? and that cost and that independence and the credibility of that is going to be the absolute critical determinant of whether we're successful in connecting digitization to ESG.
Yeah, independent verification. It's just so key here. And then the E word, the economics. Yeah, the economics. And I think that's where maybe the regulators and the public sector might have a part to play. But yeah, the economics just have to work. And it's like any technology in the beginning, it just costs a lot to get it up and running and standing. But once it's up and running and it's scalable, then it could work. And this beautiful thing about technology is it costs a lot, but then it does scale up. Maybe that's controversial, but we don't have enough time to do it properly here. But if we're just looking at trade, coming back to trade, the products that are being bought and sold between countries and so on, we have enough data points to start with. And I think there's more information that can be collected as long as it can be independently verified.
And I think what we'll see is, just speaking from a sort of fintech perspective, is we'll see customers asking us to come with those capabilities of integrating in other providers that can at least provide additional data flows or data components, whether it's Halo Trade or a whole series of other fintechs to help in a system making a determination around about, do they actually want to be involved in that finance?
Yeah, I think I would just add a couple. There's an interesting point here from on cloud providers, the risk of ESG compliance. Let's call it ESG compliance, right? Once we've got standards out there, we start talking about ESG compliance. The risk of ESG compliance is it moves down the route of AML compliance, right? And I think, having worked in the bank for a long period of time and involved in a number of projects on this front, there's a lot that was spent by the banking industry that basically added no value to the outcome, which is to catch the bad guys, right? And so my worry with ESG is that we end up down the same route, particularly if regulators kind of get involved, is that there's a lot of money spent tracking and creating red flag. I think we all started doing AML manually, then we moved to red flag automation, and then eventually we're moving to sort of using machine-based learning to try and identify scenarios that look like they are breaking they're breaching AML guidelines. And I think the learning that's there is, can you move with ESG directly to using technologies such as machine-based learning to identify things that just don't make sense, and therefore question the credibility of the data that's on there. So is the answer not about worrying too much about the data that's on there, but running intelligent AI sense checking over the data to essentially demonstrate potential breaches that then allow for deeper dives so that you're not adding to the overall cost burden. So are there other ways of addressing the same problem and coming at it from a different perspective? So that's the thought process, because other than sort of modern slavery laws, that there isn't a lot of laws environmental laws, but a lot of the SDGs are not covered by laws right now.
Exactly.
At that point, Michael, because it's calling for
another topic, just in the interest of time, is just sort of around, we've been talking so much about data, but trade is still very paper-based, right? It's not as if we have this structured data that's easily available all the way along supply chains. And even throughout the pandemic, when the only way that we could work was digitally, we have still not seen sort of critical mass be reached in terms of trade digitization. So I wanted to get a feel from you, do you believe that pressure around ESG or a greater focus on ESG might be the tipping point that brings trade into the digital age?
I disagree with your premise, Eleanor. Sorry.
Okay.
So trade is paper-based in the communication of transactions from one party of the supply chain to the other. But within each party, if you ask a shipper, most of their data is electronic. Yeah. You ask a bank, most of our data is electronic. I mean, we've had to probably input it, but it's there, right? So, that's why I think that there is data available in each organization. So you could start doing things with that data that's there. And I think back to the point that was made in the chat that, you know, that you can actually act on data that's there. But you know, to answer your question, I think it's definitely adding to the business case that's there.
Yeah, I mean, I think to Michael's point, I think it is yet another lever that adds to the case with digitalization, right? Without question. And we talk to banks across the world in regards to that, and in regards to how the pandemic hit them just from an operating principle perspective. I mean, one COO of trade jokingly said he knew the DHL courier better than some of the people in his family based off the back of how much paper he had to ship around the world. So it's without question, we've seen that change from March 2020. Basically, yeah, we saw the accelerator just being pressed down. I think what will happen is you'll see the pressure from investors, the pressure from consumers, and the pressure from regulators, and it will just drive additional flows that need to be considered in that digitization, without question. But I think that the part that's been called out across the other panelists is well, what rules do I apply? How do I make the decision? I've seen it elsewhere in other regulations where at World Economic Forum, people call out particular things, and then when they go back to their own country, they go and do data localization laws, for instance, right? We need to be open, and then they go and bring in data localization laws. So I think it's going to be, back to paraphrasing Greta, I mean, how quickly do we get away from blah, 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 and into how do we really move this forward? But back to Marisa's point right at the start, we need to start. And we need to use what we've got, and then things will iterate past that point.
I think there's no silver bullet. So there's actually many different streams that all happen at the same time. I think Mike's right. Like as a bank, we have the basic information. It is in our system. It's not just out on the paper. So I want to say for the fourth time, we've got description of goods, the buyer, the seller. We've got enough information to kind of take that first call, and then tech solutions can really help us to fill in kind of that ESG profile for that particular trade and transaction. So that's kind of one stream of things. But we also have to really look at what other information that's not currently being captured we need to get from all the very beginning part of that supply chain as well, so that we get that visibility also. And then I was at a really good conference hosted by the UK Export Finance, and all the ECAs are out there saying they're really enthusiastic about accelerating the path to net zero. They themselves have dates that they're setting. Again, it's a pledge, dates where they themselves will get to net zero. But more importantly, the transactions that they're going to be a part of, they've got a path for that as well. So again, it's more than the emissions of our own company, and each and every company and organization. It's the realm of influence that we have, whether that's for a large buyer, small buyer, whether that's across supply chains, whether that's through the financing that we provide, or the risk mitigation kind of services that we provide as a bank, and so on. So I'm a glass half full person for sure. I'm more optimistic, although I'm this topic is so big, it's so challenging that it's hard to be an optimist, but I will try my best. And also, it's not just about penalizing the bad, kind of the brown and the bad trades as well. I think again, Rebecca Harding, because of the data she sees, I think one in every $5 of trade is spent on something that is in a positive way towards an SDG rather than negative. So that's 1 in 5. If we can have better visibility, can we make that 2 in 5, or can we increase the amount of financing, funding, and solutions we are towards kind of goods and services that have a positive impact on SDGs?
Yeah, I like the suggestion from Michael, which I thought was pretty consistent and solid, around learning from the compliance space. And doing a kind of a self-leapfrogging, because the technology enables us to do things that we couldn't do 10 years ago in the compliance space anyway. So I think there's an opportunity to do some leapfrogging when you parallel the compliance space with the ESG space. One quick data point, the FT put out a piece in January 2019, and I've quoted this so many times now that it's like stuck in here. The UK banks spent something like 5 billion sterling in a single year on AML CFT compliance, financial crimes compliance. That 5 billion resulted in 28 cases being initiated, 40 prosecutions, and a whopping 52 million pounds of illicit funds being diverted. So spend 5 billion to divert, prevent access to 52 million makes no sense. And I know compliance isn't about the dollars or the sterling or whatever, but the proportionality of it just illustrates the lack of efficacy. And we do need to avoid that in ESG. Eleanor, to your original question, I think ESG, and I think Iain, you put it very eloquently, it's an additional lever, right? I mean, it'll help accelerate or motivate digitization, but ESG itself isn't evolved enough to be a driver for anything at this point. It needs to grow up itself before it starts to drive other agendas. But the good news is, I think that the conversation is gaining momentum. I think we just needed to mature a little bit, and we need some urgency behind it.
And I think you need the right people in the room as well, right? I think Michael raised a good risk, the risk of unintended consequences. Like, you can have all the best intent, but if you're not involving all the right stakeholders in that discussion as you're building that framework, you might risk having all these sorts of rules that are not fixing or not getting to the outcome that we wanted to. So I really do support, businesses and finance organizations just being a part of that conversation of how to build that framework.
Yeah, that makes sense. So in the few minutes that we have left, I thought it might be useful if we go around and just get almost like your wish list of, the things that need to happen now in order for us to achieve this goal of, data feeding into better ESG performance. What are the barriers that are standing in the way? And where do we perhaps need the ecosystem to work better together? I think if we just go around and sort of each of you give those closing comments. So Michael, do you want to start us off?
No, okay. I think it's about incentivization. I mean, you'd think that the fact that we've got a climate emergency and that the regulators are beginning to move is incentive enough, and some organizations are moving, but I think any sort of incremental incentivization here would be really, really helpful. So I think I've been a big proponent of using hybrid capital or blended finance to try and solve for this problem in a big way. And if we can figure out how to make it capital efficient or significantly more capital efficient, we can therefore reduce the price to those that are actually ahead of the game and make them more competitive, because the cost of being ESG compliant is higher than not being ESG compliant today. And so anything that helps that balance redress, I think, is going to be helpful, in addition to what's happening in the external space around investors and so on.
Yeah, really good points there. Merisa, over to you.
I think I'll be really cheesy and say this is a team sport, and team meaning together everyone achieves more. So and that there are all these parallel streams that just have to happen at the same time. So it just can't be what UKIP is doing on the large value transactions. It can't just be green purpose loans and that piece. It can't just be our part in kind of trade finance. Everything has to happen, and we all kind of have to do our part. I get the example I have, which sometimes I have debates on kind of on the personal side, is like, oh, if you look at what your pension fund is investing in, then you have, was it 21 times more leverage to kind of redirect that, to put some pressure versus just steps that you take in your personal life. But I don't think it's an instead of. You can't just like rely on that and make sure your pension funds is invested in the right things and just forget about your own footprint. We just have to, every little counts, so we have to do every bit of that. And trade is such a broad word. There's so much you can look at in trade. There's the ECA type deals, there's specific trade transactions, there's supply chain finance, and I think everything just has to start moving now. We start with what we know, and then we just keep building on that. It's basically the agile method, isn't it?
Great. Iain.
I'm going to steal everything that's been said up till now, right? Which is just start. I think the incentivization will come from the regulators, the consumers, and the investors, just because of what will happen. So that links into what Merisa was just saying around about having a look at your own sphere of influence, but a little bit wider than that. I think we need to learn from KYC and AML, and actually, regulation should be an enabler, not an inhibitor, as some people would say in regards to doing that. I think there's a bit in regards to, I can't remember if it was Alexander or Michael said, we need ESG to grow up a bit as well in regards to what is it, how can we apply it? Part of that will be standards, but I used to use the phrase, it's a Lord of the Rings analogy when I talked about blockchain. You know, I said there won't be one network to rule them all. There doesn't have to be one standard, but let's start with what we've got and iterate to what makes sense from a global perspective or regional perspective, but something that people can understand what needs, you know, what it means when you put a standard in front of them, but also the part around about the independence and the verification of the data. So that's quite a lot I'd like, but I think it is. It just needs to grow up a little bit in regards to what we need to do. That doesn't mean that we shouldn't start, and we should definitely start.
Some solid action points there. Alexander, what's your laundry list?
So I think I'm going to limit myself to one, but it's kind of a big one. And I'm going to follow Merisa again. She went cheesy. I'm going to go sort of soft, fuzzy, and huggable and say, look, what we really need is a genuine conversation. And in the trade space, actually, we are uniquely placed to do that because we understand interconnectedness. And COVID has taught the whole planet that, but in the trade space, we know that inherently. And so it's important, in my view, for stakeholders to have a conversation that's solution-oriented. What do I mean by that? I'll go back to the financial crimes compliance space. We are just now figuring out that actually the regulators and the regulated entities can safely sit across the table from each other and have a candid discussion. That's not an easy thing to do, but we figured out that actually it can happen and people can leave the room and not be suddenly like, you know, facing any consequences that are terminal to either one of them. And that actually by having that discussion, the regulation is more effective, the unintended consequences are mitigated, and the regulated entities tend to behave better anyway. So I think that similar dynamic in the ESG space needs to happen, and we need a lot less sort of territorial trying to grab ownership of a piece of this problem for whatever purpose it is, commercial, political, whatever it is. We need a genuine solution-oriented approach to this. And, you know, Iain, you pointed to this whole data localization piece, and it even goes to data sharing across borders, right? All of those things require people to say, actually, this makes sense. Why don't we do what's logical here? Because we are in a bigger picture, and there is this interconnectedness that we all should have figured out by now. So it's basically, can we please learn from history and get on with it?
I think that's a really strong statement for us to end on. I think, you know, throughout this panel, it's very, very clear the linkages between trade digitization and ESG. And I think what's come out of this is that the tools are available. You know, they might not be perfect, they might not be everywhere, things might not be fully mature yet, but what I'm hearing from all of you is just get started with what we've got and we'll take it from there. So thank you very much to everyone on the panel. Thank you as well to our audience for joining us on day 2 of the Future of Strategy event. Coming up next, Rebecca Harding, CEO of Coriolis Technologies, is going to be holding a fireside chat with Andre Casterman, who's head of the FinTech Committee at IPFA, and Finion's Michelle Kiltsey, on how technology is changing trade. So thank you very much and enjoy the rest of the event.
Thanks, everybody.
Thank you. That was fun. Bye.